Everyone thinks they know what a bank does. Someone hands over their paycheck, the bank puts it in a vault, and whenever that person wants it back, it's there. Simple, safe, boring. That picture is wrong, and understanding why it's wrong is the only way to understand why banks can print billions in profit one year and disappear in a weekend the next. So let's actually build one. Let's figure out what it costs, how it makes money, and why some of the most experienced bankers in America have watched their life's work evaporate before. Forget the vault. A bank isn't a storage unit. That's what a locker is. A bank is an engine that takes money that belongs to other people and turns it into something that earns income. Here's the strange part. When you deposit $1,000, that money doesn't sit still waiting for you. Within hours, most of it is out the door, turned into a car loan, a mortgage, a small business.
You have a business line of credit, but you can still log into your app and see your full $1,000 sitting there. It looks untouched. This isn't a scam. It's called fractional reserve banking, and it's how every economy on earth has worked for the last century. A bank takes a deposit and lends most of it out, and that bank lends most of it out again. Repeat that enough times, and $1,000 in original deposits can turn into $8,000 or $9,000 moving through the economy. All from the same original dollars. For decades, U.S. regulators required banks to keep about 10% of deposits on hand at all times. That rule technically doesn't exist anymore, Hannon. The Federal Reserve dropped the reserve requirement to zero back in 2020. Banks now operate under a different set of guidelines. You hold reserves because it is smart, not because it is mandatory. But the underlying bet has not changed. A bank survives only as long as everyone trusts it. Let's say you actually want to open one. Before you accept a single deposit, you're going to need to ensure that nobody doesn't ask for their money back on the same day. Your state. Second, deposit insurance from the FDIC, which won't say yes unless your business plan looks like it can actually survive a downturn and remain solvent. This process alone can eat 1 to 3 years and cost anywhere from a couple $1 million to tens of millions, depending on the size of the operation. You are already out several $1 million. You need 2 separate approvals. First, a charter, which you must obtain either from a federal regulator or from the state. Then there's capital felony, and this is where people get confused. Capital isn't the money customers deposit. Deposits are debts you owe. Capital is money that is actually yours, sitting there specifically to absorb losses. Regulators generally want to see somewhere around 9 to 10% of assets backed by real capital for a smaller bank. So if you want a bank capable of lending out $100 million, you need. Then there's capital felony, and this is where people get confused. Capital isn't the money customers deposit. Deposits are debts you owe. Capital is money that is actually yours, sitting there specifically to absorb losses. Regulators generally want to see somewhere around 8% capital, around 9 to 10% of assets backed by real capital for a smaller bank. So if you want a bank capable of lending out $100 million, you need time. Payroll alone runs into the millions every year. JP Chase spent over $22 billion in a single quarter in 2024 just on operating expenses, before even counting what they invested in. It pays out in interest. Then technology. Every swipe, transfer, and login has to be recorded, verified, and protected from people actively trying to steal it. Cybersecurity for a large bank is a billion-dollar line item on its own. Then compliance. Anti-money laundering checks, fair lending laws, stress tests, quarterly filings to multiple agencies. Banking might be the most heavily supervised industry in the country, and staying compliant requires an army of lawyers and officers who produce zero revenue but are completely non-negotiable. And finally, bad loans. No matter how careful you are, some borrowers won't pay you back. Banks have to set aside money in advance for exactly this. It's called a loan loss provision. And in a bad year, it can quietly swallow most of your profit. So how does a bank make money at all with all these costs stacked against it? The core idea is the spread. You pay depositors a small interest rate, maybe 0.5% on a savings account. You charge borrowers a much bigger rate, 7% on a mortgage, higher on a credit card. The gap between what you pay and what you charge is called the net interest margin, and it's the primary engine of the whole business. On top of that, banks collect fees from almost every direction: account fees, wire fees, overdraft charges, and interchange fees every time someone swipes a debit card. Overdraft fees alone generated close to $10 billion across account fees, wire fees. They add up to real money. And for the biggest banks, there's a whole additional business, investment banking.
trading, wealth management. That's part of why J. Morgan alone posted a $58 billion profit in 2024, the biggest annual profit any American bank has ever recorded. Here's what makes banking unlike almost any other business. You're generating profit almost entirely with money you don't own. A restaurant owner risks their own capital. A bank risks customer deposits and only backstops the whole thing with a thin sliver of its own money. That's called leverage, and it's the reason a bank can post a 20,000% return on its own capital even while only earning 1% on its total assets. But leverage cuts both ways. If a bank holds $50 billion in deposits and only $5 billion in its own capital cushion, it only takes a $5 billion loss, just 10% of what it owes depositors, to wipe it out completely. Let's look at two banks that looked completely fine right up until they weren't. They weren't. The first ran for over 100 years, built into one of the largest savings banks in the country, with more than 2,000 branches and close to $390 billion in deposits. It had leaned heavily into risky mortgage lending during the housing boom, betting that rising home prices would keep covering for it. When prices fell and a major Wall Street firm collapsed in September 2008, panic spread. Depositors pulled out more than $16 billion in just over a week, over 11% of everything the bank held. Regulators stepped in and sold what remained for less than $2 billion. Investors who had backed it for decades lost almost everything, practically overnight. The second is even faster. A California bank built specifically to serve tech startups and venture capital firms had grown explosively. Its deposits doubled in a single year during the pandemic tech boom. It parked much of that money in long-term government bonds, which felt safe because government debt basically never defaults. But when interest rates climbed sharply in 2022 and 2023, the value of those long-term bonds sank. Startups were also burning cash and pulling deposits at the same time. When the bank announced it had sold part of its bond portfolio at a loss and needed fresh capital, panic didn't spread by mail or phone calls.
Compliance, insurance, and provisioning for bad loans, you might clear around $600,000 in actual profit a year. At that level, at that rate, recovering your original $15 million investment takes roughly 24 years, and that is only in the good scenario that we have calculated. Now raise interest rates by 2 points while half your loans are locked in at old fixed rates. Your margin gets crushed, your deposit costs jump significantly as well. Immediately, and suddenly you're losing money every month. 2 bad years back to back, and you've burned through a quarter of your entire savings just to keep. You need a strong capital cushion. 3 bad years, and regulators start asking hard questions. Banking, when it works, is one of the most profitable businesses that has ever existed. It's why some of the wealthiest families in history chose to own banks instead of factories. The distance between being completely fine and being seized by regulators can be measured in days and sometimes even in hours, So if you ever dream about owning a bank, understand exactly what you would be buying. It is a machine that runs entirely on trust, and the moment that trust runs out, nothing you have built can ever truly outrun it or escape the consequences.